The Lindhal Tax Solution. Intuitive discussion. The Lindhal tax is a theoretical solution to the problem of efficiently financing public goods. It was developed by the Swedish economist Erik Lindahl, 1891, and is central to understanding the voluntary exchange approach to public finance. Intuitively, the Lindhal solution is an idealized mechanism where the cost of a public good is perfectly shared among citizens based on the marginal benefit each citizen receives from that good. It moves the provision of public goods from compulsory taxation to a voluntary, market-like exchange. 1. The core problem: public goods and the free rider dilemma. Public goods, like national defense or basic research, are characterized by non-rivalry. One person's consumption doesn't reduce its availability to others. Non-excludability. It's impossible, or too costly, to prevent people from consuming the good even if they don't pay. The dilemma. Because of non-excludability, rational consumers have an incentive to be free riders, to enjoy the public good without contributing to its cost, hoping others will pay. This leads to the market under-providing the public good, or failing to provide it at all. 2. The Lindhal solution: pricing by benefit. The Lindhal solution proposes a mechanism to overcome the free rider problem by replacing a uniform tax price with a personalized tax share based on individual marginal benefit. Key concept: Lindhal prices. A Lindhal price is an individual's personalized tax share, a fraction or percentage, that equals the marginal benefit they receive from the public good at the efficient level of provision. If an individual receives 60% of the total benefit from the public good, their Lindhal price, tax share, is 60%. The sum of all Lindhal prices, tax shares, must equal the total cost of the public good. Intuition: voluntary market exchange. The Lindhal solution mimics a private market for a public good. Demand revelation. Each person is asked how much they would be willing to pay for one additional unit of the public good, their marginal benefit. Efficient level. The efficient level of the public good, G***, is reached when the sum of all individuals' marginal benefits equals the marginal cost of providing that unit. Cost sharing. At this efficient level G***, the marginal cost is broken down into personalized shares, the Lindhal prices, such that each individual pays exactly their marginal benefit. Since everyone pays their marginal benefit, they are theoretically willing to contribute voluntarily. 3. Suitable example: street lights. Consider a community with two residents, Alice and Bob, who need to decide on the number of street lights, G, to install. Assume the marginal cost, MC, of installing one street light is constant at $100. Street lights, G, Alice's marginal benefit, MB_A, Bob's marginal benefit, MB_B, sum MB_I, total benefit, marginal cost, MC. 1. $80, $60, $140, $100. 2. $50, $40, $90, $100. Optimal level. The community should install one street light, G to the power of * equals 1, because the total marginal benefit, 140, exceeds the marginal cost, 100. Installing the second streetlight is inefficient because its total benefit, 90, is less than its cost, $100. Lindhal Tax Solution. To finance the first, efficient, streetlight costing $100. Alice's share. Alice pays her MB, which is $80, 80% of the cost. Bob's share. Bob pays his MB, which is $20, since the total cost is $100, and 80 plus 20 equals 100. Bob must be willing to pay $20, which is less than his $60 megabytes. Result: the Lindahl tax shares are 80% for Alice and 20% for Bob. Both are better off contributing their share than being without the good, and the efficient level of output, G** equals 1, is financed. 4. Why Lindahl tax is theoretical, the flaw. While the Lindahl solution is the ideal theoretical answer to efficient public good provision, it suffers from two major practical flaws, making it unusable in the real world. Information problem. The free rider strikes back. The Lindahl solution requires the government to know every individual's true marginal benefit, demand, curve for the public good. However, if individuals know they will only be taxed based on what they reveal, they still have an incentive to understate their true benefit, strategic misrepresentation, to lower their tax share. The free rider problem reappears as a revelation problem. Implementation costs. Even if the information were revealed, implementing millions of unique, personalized tax prices for every public good is administratively impossible. The Lindahl solution remains valuable because it defines the necessary condition for the efficient provision of a public good. The sum of the prices must equal the marginal cost, and each individual's price must equal their marginal benefit.